Okay. So IAS 19 is basically employees benefits. So it includes all the things that we pay to the employee as a part of benefits. Clear? So it's like
Okay,
a
clear.
provision account itself, but it has a separate standard given to it. Clear? So it could be
Okay.
anything. It could be like the holiday pay that is being given to the employee. It could be like the sick pay, sick leave given to the employee, which is paid in nature. Okay. Also, any free or subsidized goods which has been given to the employee. So whatever allowances that the employee get is dealt in IAS 19 employee benefits. Clear?
Okay,
Okay.
clear.
Now, short-term employee benefits. Okay. So benefits could be in any form, right? So if the benefits are being paid within a year or is being settled within a year itself, then that becomes short-term employee benefits. Clear? And
Clear.
short-term employee benefits are as such the wages, okay, paid vacations, sick leave, okay, bonuses, etc. Okay. And it is to be it was to be accounted for as if it is given in the year itself. Understood? So it is not
Yes.
taken when it is paid. It is taken as an accrual during the year. Understood? Okay.
Okay.
So under this scheme also, sometimes the employees are entitled to getting any profit sharing in the company or a bonus payments. Clear? So
Okay.
at this point of time, you're going to recognize the bonus payments or profit sharing when there is an obligation. That means when it is declared and stamped. Understood?
Okay.
Okay. And when you're going to record it, you should have a reliable estimate in order to record them. Understood? No?
Okay.
Okay. Now, what are the types of post employment benefits? So, post employment benefit is basically after the employment or after the tenure of the people working for you, what happens with them. Clear? So, there are
Mm.
two types of post employment benefits. One is defined contribution plan, and the other is defined benefit plan. Clear?
Yeah.
Okay.
Okay.
So, what is a defined contribution plan? In this particular system, the company is going to declare that they are going to give a fixed contribution as a pension fund for the employee. Okay. So, they are going to
Okay.
pay it as a one off item, and there is no further obligation after, or there is no further obligation once it has been paid off. Clear?
Clear.
Okay.
Okay.
And when the contribution is being paid, it is going to be taken in the P&L. Clear? As an expense. It is expensed out. Okay.
Okay.
Now, if the contributions are being kept pending, that means you're not giving them in 1 year time or it is taking more than 1 year time, then it is to be discounted. Clear?
Okay.
Now, the second thing is defined benefit plan. Okay. So this is like you're going to pay a fixed amount of pension to the employees who have left for a very long period of time. Clear? Okay.
Okay.
So in this case, the uh, benefits which is being paid out is going to be converted into the present value of whatever is happening in the future. Okay. And it is to be taken at the present value less the fair value of the assets involved. Now, how do a company make the fund? They're going to take the asset and invest it somewhere else, and they're going to reap benefits out of that assets, and the same benefits shall be given to the employees. Otherwise, it's a running fund, right? So, in
Right.
order to counter that effect the company is most probably going to allot a fund in an asset which is going to reap them some return, and these returns shall be used for paying the employees. Understood?
Okay. Understand.
Okay. Now, defined benefit scheme. What are the terms? Okay. So, after the employment, okay, if there is a defined benefit plan, then it raises a constructive obligation. Remember, in the FR, we have studied constructive and legal obligation, right?
Yes. Right.
So constructive obligation is when the company itself is advertising themselves as they are going to do something. So
Right.
naturally, it falls upon them as an obligation. Clear?
Yes, ma'am. Clear.
Okay. So how does this get recorded? the whatever fund we have, it is going to be shown as a pension fund, okay, at the year end. And we would take present value of obligation less the fair value of the assets that is being invested meanwhile. Clear?
Yes, ma'am.
Okay. The idea is very simple. Every year, the company is going to put some funds into it. Okay. And maybe if they are not investing it, they are going to invest it in at a bank. The bank is going to give them interest. Clear? Okay.
Okay, clear.
And
Okay.
the asset is probably going to make an expected returns. Okay. And the company is going to take the returns and pay to the employees when their pension starts. Clear?
Okay, clear.
Okay. Now, the problem is the fund is not going to match with the pension liability. It is not. Okay. There would be differences. Okay. So there would be surplus or there would be deficit that is to be put into. Clear?
Okay, clear.
Okay. Now, so you see, whenever things happen, that is, we have got an estimate in the future to take, right? For
Right.
pensions. Now, the problem is this is not being decided by us. This is not decided by a mere evaluator. It is being decided by the actuary. Clear? The person who decides on these stuffs is called actuary. Clear?
Okay.
Okay. So when the actuary is going to calculate things, we're going to make changes in our financial statements accordingly. So in SBR, you're going to dig deeply into this matter, but in AAA, you just need to know the basics. Clear?
Okay,
So when
clear.
the actuary says us to, or the actuary has estimated some amounts, we would have to make the same changes in our financial statements. Clear?
Okay,
And
clear.
when this occurs, there would be some differences in our financial statement and it is going to be recognized in OCI. Clear?
Okay.
Understood, no? Now,
Yes, ma'am.
past service cost. Past service cost. So, when there is a change in the pension plan, okay, which is going to make us give a higher pension than before, then that is called a past service plan cost. Clear?
Okay.
Okay. So whenever that happens, we are going to record it immediately. And this might happen because some employees have been coming in the organization. Clear? Okay. So
Okay.
this is going to increase your expense and it is going to increase your liability. Clear?
Okay, clear.
Understood? Now, three, plan curtailments or settlements. So every year there might be employees who have been under pension who's going to go off, right? So it should
Right.
come under settlements. Clear? So when this
Okay.
curtailment occurs, also there would be a gain or loss in difference between the one that we have recognized and one that is being paid out, and the difference in the gain or loss would be recognized. Clear?
Okay, clear.
Understood? So any amendments which is going to benefit the pensioners are going to negatively affect us. Clear? Okay. So in this case,
Yes.
you're going to debit the profit or loss and credit the present value of defined benefit obligation, any increase or decrease in the benefit plan. Clear?
Okay.
Understood? Fourth one,
Yes, ma'am.
current service cost. Current service cost means during the year, how much our service cost that we have been incurred or we have been accruing, that is called current service cost. Clear? So it's like an
Okay.
expense. So debit income statement and credit pension liability. Understood?
Yes, ma'am.
Okay. Now, when we are going to pay off the pension liability, or when we are going to, sorry, not paying, when we are going to forecast a pension liability for the future, it has to go with the discount rate, and that is the interest cost involved in the pension plan. Clear? So it's an
Oh,
expense, you're going to debit it and you're going to credit the pension liability in order to make it into present value. Clear, no?
okay, ma'am.
Now, expected return on plan assets. So, plan assets are basically the assets that you have invested in, which you assume that out of those returns from the asset, you're going to pay off the liabilities of the employees. Clear?
Okay,
Okay.
clear.
So, it could be interest, it could be dividends, or any other revenue which you're going to gain from the pension assets. Okay. And it is expected to create a return for a AA rated corporate bonds. Now, what is a AA rated corporate bonds? It is the most premium corporate bonds which we are going to get returns. Clear? So whatever
Oh,
return, whatever you have invested in, it is always going to be compared with AA rated corporate bonds. Clear?
okay, clear.
Any doubts here?
No, ma'am.
AA rated corporate bonds, it's a financial investment. And it's the premium one. That is the most guaranteed one with the most secure one with less returns. Okay. Minimum returns because it's less risky. So less returns. So your
Okay,
whatever you are investing on the pension assets, it should create or it should be always matched against the AA corporate bonds. Clear?
okay, got
Okay.
it.
So what does this mean? The companies are not to be setting their expected returns according to the asset held in the plan, but they're going to take the AA corporate bonds as their base. Okay.
Okay,
Understood? So why is this there? It could encourage them to invest in more secure vehicles than is the current case. Okay. So that means they're going to invest in a very cautious way. Clear?
okay, clear.
Okay. So the reason behind setting up this particular clause is that in order to improve the transparency and consistency. Clear, no? Okay.
Okay,
So
clear.
in this case, when you're going to invest in an asset, it is going to be debited pension asset, and whatever interest received that the interest that you're going to receive is an income, so it is credited. Clear?
Okay, clear.
Understood?
Yes, ma'am.
Okay. Now the effective interest cost, okay, and the return interest cost is going to be netted off against each other. Clear, no? Okay,
Yes,
and
ma'am.
this is because they use the same discount rate. Okay. So suppose
Okay,
if the fund has more assets than liabilities, then that means a surplus has been created in your plan asset, right? That means your EOS is very less. Okay. But uh, by the use of the plan asset, you're gaining more, right? Okay.
right.
So then it will be a net interest received. Clear? Now, if the fund has more liabilities and less asset, then the interest would have to be paid out. Clear? That means the liabilities would gain more interest and the asset would gain less interest. Understood?
Okay, understood.
Okay. Don't get confused. Okay. Seventh term, contributions to pension fund. Okay. So this is simply like we are going to increase our plan asset over the years. Maybe if we are going to invest in it. So then you're going to debit the pension asset and you're going to credit the cash because cash is going away. Clear now?
Okay, ma'am.
Now, eighth one, benefits paid. Okay. So these are the actual benefits that is being paid out to the employees in cash. Clear? And since we are using plan asset, it is not basically going as a way of cash. It is just going to reduce our pension asset. Understood?
Okay,
Okay. And it is going to reduce our pension liability. Now, the confusing thing, the eighth one, benefits paid and the curtailment here. What does this have to do with it? See, curtailments happen when any employee leaves midway. Okay. So for the
okay,
pension to work, the employee needs to complete a fixed level of service, right? Like, let's say 25 years or 50 years of service, right? So when he
right.
leaves before that, what happens? He gets disconnected from the plan. Clear? So in
Okay,
this
clear.
way, there would be reductions in the benefits. Understood? And this is
Okay,
like they have completed it and they are being paid out. Understood?
okay, understood.
We'll stop here and continue tomorrow. All right.
Okay, ma'am.